Hello and welcome. Today, we're going to talk about payment methods in trade finance and how they can help you and your business grow and expand internationally. Payment methods in trade finance. In commercial transactions, payments need to be made securely and in a timely manner. When establishing a new relationship, buyers and sellers tend to use intermediaries, such as banks, to limit risk by ensuring that payments are made on time. As trust develops between the buyer and seller, businesses may move to other payment methods, such as cash in advance or providing trade credit on open account terms. Payments in trade finance present various types of risks for both the importer, buyer, and the exporter, seller. As a business owner, it's important to understand the different risks of each type of payment method to see which one is most favorable and suitable for your business needs. This article will examine 4 types of payment methods: cash advances, letters of credit, LCs, documentary collections, DCs, and open account sales. Cash advance. A cash advance requires the importer, buyer, to pay the exporter, seller, before the goods are shipped, placing all the risk on the buyer. Cash advances are common for low-value orders, such as purchases from online retailers. For a seller, a cash advance is the least risky payment method. It provides the seller with initial working capital to produce and ship the goods, as well as security, since there is no risk of late or non-payment. On the other hand, as a buyer, a cash advance is the riskiest payment method, since it can lead to cash flow problems and increase the buyer's exposure to financial risk vis-a-vis the seller. This method can be problematic if the goods delivered are not up to standard, are defective, or are not delivered on time. Letters of credit, LCs. Letters of credit, LC, also known as documentary credits, are legally binding financial instruments issued by banks or specialist financial institutions. A LC guarantees that the seller will be paid on behalf of the buyer, provided the terms specified in the LC are met. A LC requires an importer and an exporter, with an issuing bank and potentially a confirming or advising bank respectively. The lenders and their creditworthiness are crucial to this type of trade finance. The issuing and confirming bank effectively replaces the buyer's payment guarantee, reducing the risk for the supplier. This is called credit enhancement. An LC transaction usually happens as follows. An importer agrees to purchase goods from an exporter. A purchase order, PO, is issued. The importer will approach an issuing bank, trade financier, who will issue an LC if the company meets the bank's criteria, e.g. is solvent. The exporter will work with a confirming bank, who will request that the LC documents be verified by the issuing bank, the importers. The confirming bank will then verify the LC and, if the terms are acceptable, the exporter will ship the goods. The exporter then sends the relevant shipping documents to the confirming bank. Once the confirming bank has examined the shipping documents in strict accordance with the issuing bank's LC terms, they will forward these documents to the issuing bank. Payment is made in accordance with the agreed terms, guaranteed by the issuing bank. The issuing bank then releases the shipping documents so that the importer can claim the goods that have been shipped. Depending on the terms agreed, the issuing bank transfers the money to the confirming bank, which will then transfer the funds to the exporter. LCs are flexible and versatile instruments. An LC is universally governed by a set of guidelines known as Uniform Customs and Practice, UCP 600, which was first produced in the 1930s by the International Chamber of Commerce, ICC. Documentary collections, DCs. In the case of a DC, the seller, exporter, will request payment by presenting his shipping and collection documents to the remitting bank. The remitting bank will then forward these documents to the importer's bank. The importer's bank will then pay the exporter's bank, which will credit these funds to the exporter. The role of banks in a document collection is limited. They do not verify the documents, assume credit or country risk, or guarantee payment. Banks merely control the flow of documents. DCs are more convenient and cost-effective than LCs, and can be useful if the exporter and importer have a good relationship. They are often used if the importer is in a politically and economically stable market. Open account. In an open account transaction, the buyer pays the seller upon arrival of the goods, usually 30 to 90 days later. This is advantageous for the buyer, but adds substantial risk for the seller, meaning it is often used when the relationship between the two parties is already strong. Open account trading helps to increase competition in export markets, and buyers often pressure sellers to trade on open account terms. As a result, sellers are more likely to seek trade finance to fund working capital while they await payment. Sellers can use trade credit insurance to reduce the risk of trade losses, which can result from a buyer's default, insolvency, or bankruptcy. If you enjoyed our video, please like, comment, and share so that this video can reach more people. Thanks for watching and see you next time.